Forbes Africa's Chris Bishop caught up with Tom Albanese, CEO of Vedanta Resources. Here is that conversation.
Well, we've been through these cycles before, of course. We've seen periods where prices are up, prices are down. I think what we're seeing now would be just fundamentals of supply and demand. I think that the global economy is in reasonably okay shape. U.S. is running well. Europe's going to be holding flat, and China is slowing. It's not declining, but China's growth rate is slowing. So in this environment, the growth rates for commodities, oil, metals, is much slower than it would have been 5 years ago. At the same time, we have all this new supply that has been invested in over the past 10 years, just starting now to get into the market. So in oil, we have an oversupply in oil. A lot of it is shale gas in the U.S. In iron ore, we have a lot of new supply coming in from Australia and Brazil, coming into the iron ore market. And in copper, you have a couple new copper mines that have been invested for quite a while that are just coming in. So new supply, slow demand growth means you have surpluses and prices have gone down. And I think, again, this is something we've seen in the past. I've been in this career for 35 years or more, and I expect to see even more of this going forward in the future. But again, looking ahead, the longer prices stay low, the less investment in those sectors. So for us, the markets that we're in that are actually doing quite well, zinc and aluminum, actually were the dog metals of 10 years ago. So those things that are in the doghouse for a while, you don't see people investing in them. And so then you start seeing the surpluses. They dissipate over time, they turn into tightness. There hasn't been money going into it, and then that tightness turns into higher prices. So for us, we have low-cost production, and we have a diversified portfolio.
And you're a mining veteran, you were with Rio Tinto before. How would you compare this time we're going through to similar periods in the past?
Well, in 2008, 2009, where we had difficult commodities and difficult equity markets, similar to what we see now, the rest of the world was a scary place. I was meeting with your anchorwoman at the time, and in London in probably February of 2009, and it was a scary place. We were both wondering, is there a cliff that we're all getting ready to either hit, or a waterfall we're ready to go over? It's a different picture now. I mean, what you see now is a more robust global macro environment. We're not sort of dealing with existential issues in terms of the global economy. We're dealing with the hangover effects of all this stimulus that's put into place. But I'd say that it feels better now than it did in 2009.
Coming to Africa, what's the feeling you're getting from foreign investors or fellow foreign investors here at this conference?
I think in this environment, capital markets have left the sector, and they're certainly shying away from risk. So I think what you're seeing now would be that the markets have doubled up their exit in emerging markets, in Africa, in Asia, and they're preferring to concentrate on things that are sure things. So OECD markets, if they're going to stay in mining, they're going to stay into there. So I think for new emerging operations, new emerging companies in emerging countries, it's a very difficult time to get capital in this environment. And so you can see it around the halls here of Indaba, where you probably have more service providers than you have mining companies.
Exactly, and also there is a lot of reluctance where people are still uncertain about regulation across the continent. What do you think this continent can do about that?
I think that the uncertainty of regulation and fiscal systems is not an issue isolated to Africa. It's something we're seeing on a global basis. In many cases, I think that governments and treasuries have seen the very strong profits made 5-10 years ago, and they're saying, how do I get some of those profits? Well, the sector doesn't have them now. So what we're seeing is a sort of a renewed push for increased revenues to the state in an environment where many of these companies are barely standing on their own as they are. So if anything, that repels capital even further from investing in Africa.
An analyst mentioned to me the other day that they felt a lot of mining companies were just trying to hold on in this cycle, waiting for the next improved cycle. How much water do you think that holds?
Well, I think, again, in this kind of pricing environment where new investors aren't coming in, existing investors are thinking of exiting that sector, all we can do is hold on. All we can do is preserve our current businesses, ensure that our businesses are producing the cash flow, that we can continue to run those businesses, preserve options for growth, but don't exercise those options for growth today.
And speaking about holding on, you own the Konkola mine up in Zambia, and there's a lot of talk in Zambia at the moment. The government's trying to impose an 8% and a 20% royalty on copper sales at a time when commodity prices are falling and the industry is struggling. How does Vedanta view this?
Well, I think the copper belt in Zambia was struggling by and large at $6,500 copper. And then it was struggling even more at $6,000. Now we're in a price environment of $5,500 to $5,700. So, I think actually the whole copper belt is in a situation, first of all, it cannot attract capital, and it is barely holding its own. And I think that we're in an environment, certainly just speaking for Konkola copper mines, we're in a negative cash mode right now just to run our businesses. And whether it's you're running a grocery store, you're running a farm, or a news studio, if you're ever in a negative cash flow mode, that augurs poorly. So again, I want to keep the positive eye on. I want to respect all of the interests that are very, very, very important around Konkola copper mines. Notably the new government in Zambia, very, very important, and we do congratulate the new president. But we also have to be realistic and recognize that anyone that's running a business that's losing cash flow can't just sit and accept the status quo.
And just last but not least, what are the copper mines of Zambia as a whole? I'm told there's going to be a lot of talks going on this year. What can they do about it apart from merely lobby?
Well, look, I think that every company will have its own unique questions, its own unique history, its own unique history. And so, I can't speak for what everyone will be doing, but certainly, nobody is got a smile on their face at these kind of markets, and it's incumbent on everyone to work together, find a solution, so that as we look ahead, copper's flowing into the copper belt. Right now, we're in an environment, sort of a unique environment where the DRC side of the copper belt has more copper production than the Zambian side of the copper belt, and that must be the first time that we've seen that literally in decades.
And the future? Do you think the companies will stay in Zambia?
I'm an optimist. And, again, I look at the geologic potential. I look at the grades of the copper belt. I recognize it's deep operations, it's wet operations. They need modernization. They need to be moving toward mechanized businesses. But if we can make all those pieces work, it's the place to be.